The Federal Reserve. All right, y'all. So if you don't know what the Federal Reserve is and what it does, then you better pay close attention, as the Federal Reserve's policies are uber important to your life and to your wealth. First, the Federal Reserve System is the central bank of the United States and consists of 12 Federal Reserve districts, each having a Federal Reserve Bank and its own governor. Now bear with me as I list its 5 general functions. These functions are done to promote the effective operations of the United States economy in the public interest. First, it conducts the nation's monetary policy to promote maximum employment, stable prices, and moderate long-term interest rates in the U.S. economy. Number 2, it promotes the stability of the financial system and seeks to minimize and contain systemic risks through active monitoring and engagement in the United States and abroad. Number 3, it promotes the safety and soundness of individual financial institutions and monitors their impact on the financial system as a whole. Number 4, it also fosters payments and settlement system safety and efficiency through services to the banking industry and the U.S. government that facilitate U.S. dollar transactions. And number 5, it promotes consumer protection and community development through consumer-focused supervision and examination, research and analysis of emerging consumer issues and trends, community economic development activities, and the administration of consumer laws and regulations. Hopefully, you're still paying attention, because here's how what the Fed does can affect you personally. With all that being said, the Federal Reserve's policies since 2000 have caused some serious bubbles in the housing and stock markets. Those bubbles have created some serious wealth and have also destroyed some serious wealth, so let me explain. First, let's revisit the mortgage bubble in the early portion of the 2000s. After the dot-com market collapsed in 2002, the Federal Reserve cut short-term interest rates to just 1% in hopes to stimulate the economy. Because interest rates were so low, it drove investors to search for alternative investments that might offer a higher return than Treasury bills. And boy, did investors find that alternative in mortgage securities, which provided a higher return over and above T-bills, in addition to perceived safety, since the U.S. housing prices had never collapsed before. With demand for mortgage securities driven by higher return speculation and supply driven by Wall Street's greed, the result was an explosion in the number of mortgage securities. Thus, no document mortgages and zero down interest only mortgages were created, resulting in a massive bubble in housing prices. And then in 2008, both the housing and stock markets both tanked. All that wealth created and then wiped out. Now, you would have thought the Federal Reserve would have learned its lesson, but oh no. Instead of letting the markets correct themselves by instituting rational monetary policies, it decided that it was going to help enact similar policies that helped cause the bubble, but on steroids this time, to help get the economy going again. Not only did the Federal Reserve cut interest rates below the 1% Fed funds rate it currently had, it decided to start up its own printing press via quantitative easing. Thus, the same dynamic that created the mortgage bubble, yield-seeking speculation caused by near-zero interest monetary policy, and now with the insane amount of quantitative easing from 2008 through 2022, the Fed gave us an extremely long speculative period. The speculation this time was broader and more sustained because the Federal Reserve's reckless behavior was even greater this time around. To help you understand a little better, let's get an understanding of what quantitative easing is and look at the federal funds rate over the years. First, quantitative easing, otherwise known as QE, is where a central bank purchases long-term securities from the open market in order to increase the money supply and encourage lending and investment. Buying these securities adds new money to the economy and also serves to lower interest rates by bidding up fixed income securities. It also expands the central bank's balance sheet. Now, at its most expansive time, the Federal Reserve was printing $120 billion a month and using that money to buy $80 billion a month of Treasury securities and $40 billion a month of mortgage-backed securities. Because it was buying so much in mortgage-backed securities, it helped drive mortgage rates to all-time lows. Between 2008 and 2022, over $8 trillion was added to the Federal Reserve's balance sheet. That is $8 trillion that didn't exist before, which got pumped into the U.S. economy. Mind you, this debt was in addition to the insane amount of debt that Congress approved between this time period also. Here's a chart to show you how much quantitative easing was done. Now, let's take a look at the federal funds rate. The effective federal funds rate is the average interest rate that banks pay for overnight borrowing in the federal funds market. The Federal Reserve uses certain tools to adjust this rate because it influences other interest rates, such as those that you pay on credit cards, mortgages, and bank loans. It also affects the value of the US dollar and other household and business assets. It is the world's most important rate, and the federal funds rate indirectly influences even longer-term interest rates, and it helps to manage job growth and declination. And lastly, it helps to manage inflation. So here's a chart of the historical federal funds rate. So let's look to see how these policies had real-world effects. During the period we discussed, the stock market rose from 6,594 points in 2009 to 36,934 points in early 2022 before it started its correction. Understand, investors like cheap and new money, and that is what the Federal Reserve provided investors by artificially keeping interest rates low and adding trillions of new dollars. And because of this, the median cost of a home increased ridiculously. In the fourth quarter of 2008, the median price was $180,100, and by April of 2022, the median cost of a home soared to $391,200. And when you have cheap money, it creates more demand in housing and thus drives up housing prices. As you can see, because of these monetary policies, the Fed helped drive valuations to insane highs, and the Fed-induced speculation was also more than likely the root cause of the bubbles in the meme stocks, NFTs, and cryptocurrencies. Because of out-of-control inflation in 2022, the Fed started to change course, and not only did the Federal Reserve begin to raise the federal funds rate, it also began quantitative tightening to fight inflation. So let's understand what quantitative tightening is now. Quantitative tightening is a contractionary monetary policy applied by a central bank to decrease the amount of liquidity within the economy. A central bank implements quantitative tightening by reducing the financial assets that it holds on its balance sheet by selling the financial securities on the open market. When the Federal Reserve enacts quantitative tightening, it should come as no surprise that the opposite effect may happen to the stock market for a period of time. How much a drop of the stock market is unknown because we've not really seen quantitative tightening to this effect. As for the housing market, tightening will affect mortgage rates, which those rose by 2+% in the first quarter of 2022 because the Federal Reserve was going to stop buying mortgage-backed securities on top of selling the ones they owned. Therefore, if you pay attention and understand what the Federal Reserve is instituting policy-wise, then you can take advantage of investment opportunities that will be brought about by the Federal Reserve's policies, and you should not be caught by surprise when a downturn is coming in the economy, housing, and stock markets.